Welcome back to the Deep Dive. Today, we are cracking the code on one of the most opaque processes in personal finance, how insurance companies figure out exactly what your life is worth and, of course, what they're going to charge you to insure it.
Right. It can feel like some kind of magic, but it's really just pure math. We're doing a deep dive into the sources covering the, let's say, mysterious world of underwriting, where actuaries and risk analysts determine your mortality risk, assign you a class, and then calculate your premium.
And our mission here is to unpack that whole process, everything from the first medical exam to the final, really crucial policy delivery. We'll look at the specific client factors that move the needle and even reveal a few hidden pitfalls in some common coverage types. This is about knowledge that translates directly into consumer power.
Exactly. And to set the foundation, we really need to understand the underwriter's starting point.
Yeah.
They don't just pull a number out of thin air. They begin with a baseline risk score. Let's just call it 100 for simplicity.
Okay, the baseline is 100.
Correct. So this 100 represents the theoretical standard person of your exact age. From there, the underwriter compares all your personal data, your health, family history, hobbies, your job, against that standard. If you present less risk than that average 100, they subtract points. If you present more risk, they add points. And that final adjusted score, that's what slots you into a definitive risk class.
So let's unpack those classifications, because regardless of the final score, you land in one of four main categories, right? These are the pillars that determine your final rate. What's the most common one?
That would be the standard risk category. This is where most applicants land if their health is, generally good and they don't have any major risk factors. If you're standard, you pay the standard rate, which is, by definition, the baseline premium that everyone else is measured against.
Okay, so then we have the people who are statistically exceptional, the ones who are quite literally better than average.
Right. Those fall into the preferred risk categories. They are eligible for premiums that are lower than the standard rate. But, and this is a really important distinction, you typically need to undergo additional medical screening to prove that exceptional health status. The insurer isn't just taking your word for it that you eat your vegetables. They need hard data to justify giving you that lower rate.
So if I'm extremely healthy, but I just don't want to go through all the extra blood work, I might just end up in the standard class and pay a little more just for the convenience of it all.
Exactly. It's a trade-off.
Yeah.
Now, moving in the other direction, if you represent an above-average risk, but you're still considered insurable, you fall into the rated risk class.
And what does that mean in practice?
It means higher premiums, sometimes substantially higher, depending on the severity of the risk. We're talking about chronic conditions or, hazardous jobs.
And then finally, the toughest outcome, the final barrier.
That is the declined category. This means the underwriter has decided you represent an uninsurable risk based on the company's mortality tables. Coverage is just denied.
Is that always permanent?
Not always. Sometimes they'll specify a reapplication timeline if the risk is something that might decrease, but yes, it can be permanent. The door is closed.
Once you're assigned a risk class, say you're standard or rated, is that decision just locked in forever? Or are there ways to fine-tune the policy for one specific risk factor?
Oh, there's absolutely fine-tuning. It usually involves something called an exclusion. This little mechanism allows the insurer to issue the policy at the determined rate, even a preferred one, but they limit their own financial liability based on that one specific isolated risk.
That sounds like a pretty technical workaround. Can you give us an example? How does that benefit both sides?
Sure. Let's take the case of Michael. He's a Canadian citizen, exceptional health, qualifies for preferred rates. His risk score is well below that baseline 100. However, Michael regularly travels to Lebanon. And according to the insurer's risk data, that's a region of armed conflict. This travel suddenly elevates his risk score a lot.
So if they just applied that travel risk, he might get bumped to rated or maybe even declined.
Precisely. So to avoid that, the insurer issues him the preferred policy his health has earned him. But they add an exclusion for travel to Lebanon.
So if Michael were to die there because of the conflict, the death benefit wouldn't be paid.
Exactly. He keeps his low preferred premium, but he's essentially self-insuring against that one specific risk.
That makes perfect sense.
Yeah.
It's a very specific limitation, but it keeps his overall premium down. Now, what about adjustments after the policy is in force? Because our sources highlight a massive protection for the consumer here.
This is crucial knowledge. It's a one-way street, and it's in your favor. Once that policy is delivered and active, the insurance company cannot downgrade your risk rating.
So they can't charge you a higher premium if your health gets worse later on.
That's right. The premium is locked in for the term.
That's amazing consumer protection. They can't penalize you for getting sick.
Mm.
But what about the other way? If you were rated high, but the reason for it improves or just disappears?
Then you can absolutely ask for an upgrade. If your policy was issued as rated and that condition or activity is no longer a factor, you can request that the rating be removed or decreased.
And that would lead to a premium reduction.
Yes.
This is where the competitive market really becomes the policyholder's ally, isn't it?
Absolutely. Think about Bill. When Bill first applied, he was a commercial fisherman. A dangerous job, so he gets a high-rated policy with a hefty premium.
Okay.
2 years later, Bill leaves the fishing boats. He becomes a janitor for the local school board. His hazardous occupation risk, it's gone, evaporated. Bill should immediately call his insurer and request that the rating be removed.
And the insurer, knowing they can't raise the premium on him later, is now incentivized to lower it.
Yes, because if they refuse, what's to stop Bill from canceling that expensive rated policy and just applying for a brand new unrated policy with their competitor? Competition forces them to be flexible. They'll grant that upgrade to keep his business. It's one of those instances where the contract really favors the consumer after it's been issued.
That is a fantastic insight. So we've defined the 4 risk classes, but now let's look at the specific levers the underwriter is pulling to calculate the true mortality risk, the foundation of the net cost of pure insurance, or NCPI.
Right, the NCPI. It's the cost component that is driven purely by the probability of death. It's the raw mortality cost, before the insurer adds in their operational cost or profit margin. And the single biggest input to that calculation is your age.
Age is destiny when it comes to premiums. Risk of death goes up as you get older, which raises the NCPI. And when you look at the actual data, the increase is so. It's not a straight line.
Not at all. The premium increase is somewhat exponential. I mean, the jump between age 30 and 40 might be manageable, but that curve gets dramatically steeper after, say, age 60 or 65. The risk of mortality starts to double every few years at that point, and the premiums reflect that.
And there's a minor detail here, but it's important. How companies define your attained age. That can shift your premium a bit.
It can. Some companies use your age on your last birthday, some use your next birthday, others use your closest birthday. It's a small thing, but it can matter if you're applying right around your birthday.
Okay, so moving past age, we have gender. Statistics consistently show women outlive men. How does that actuarial fact translate to the premiums?
Well, all things being equal, male policy premiums are generally higher than female premiums of the same age. It's just because of that established mortality gap. The female rate reflects a lower long-term risk to the insurer.
What's fascinating here, and what our sources point out, is the tension that arises when underwriting gender identity, since all that traditional data is based on a binary.
It creates a huge data gap. I mean, actuaries rely on massive amounts of historical data, decades and decades of mortality tables. Because the visibility and tracking of non-binary and transgender populations is relatively recent, that necessary historical data to accurately assess risk, it just doesn't exist yet in the same volume.
So how are insurers dealing with this lack of data? It sounds like it leads to a very fragmented approach.
It truly does. We see a few common methods. Many progressive insurers will underwrite the policy based on the applicant's preferred gender. They recognize that's part of their long-term identity. However, some still stick rigidly to the gender assigned at birth.
And I'd imagine some rely on official documents or medical evidence.
Yes. Other approaches include using the preferred gender only if transition surgery or hormone therapy has been completed, or they might just strictly adhere to the gender on a passport or driver's license.
So the takeaway is,
Because of these huge variations, if you identify as transgender or non-binary, you should absolutely shop around. The difference in your risk classification and your premium could be substantial.
that is a really powerful piece of actionable advice. And a related note, if someone is planning gender confirmation surgery, the insurer will often postpone the application.
That's right. Any major surgical procedure introduces a temporary acute risk. They need that to clear before they can assess the long-term mortality risk.
Okay, we talked about risk classes earlier, but we need to underline the sheer dollar impact of health and lifestyle, specifically smoking. How big is that variance?
It is the single largest variable you can control. Being classified as below standard risk, which is common for smokers, results in, well, much higher premiums. When you look at the charts, the premium spike between the best preferred class and the worst smoker class is dramatic. We're often talking a 200 or 300% difference in cost.
So quitting smoking can literally change your financial outlook for decades.
Absolutely. And then there are hazardous occupations and hobbies. We used build a fisherman earlier. Dangerous jobs immediately lead to higher ratings. Hazardous hobbies or avocations like rock climbing or skydiving are usually handled with an exclusion, like Michael's travel. But if it's frequent or extremely dangerous, it could still get you a rating or even a denial.
Okay, we've covered the client side. Let's pivot now to the factors from the insurance company itself, which affect premiums for new policies across the whole market.
Right. There are three main financial factors that set the overall price point for an insurer. It's mortality costs, administration costs, and investment returns.
So if the insurer is paying out more claims than they expected, higher mortality costs, they have to adjust.
New premiums will increase to compensate. Likewise, the cost of running the business, selling, underwriting, processing claims, that's partially covered by premiums. If those expenses go up, rates go up.
And the third factor is how well they invest their money.
Insurers hold vast reserves of premium money that they invest. If their investment returns drop unexpectedly, they have a revenue shortfall, and premiums for new policies generally have to increase to make up for it.
This all sounds like a lot of financial exposure, especially for multi-million-dollar policies. If an insurer approves a $20 million policy, how do they protect their own capital?
They use reinsurance. Every single company, no matter how big, sets an internal cap called a retention limit. That's the maximum amount of coverage they are willing to take on for one single person. This ensures a single massive claim doesn't jeopardize their whole balance sheet.
So if a client wants a policy that's larger than the company's retention limit, what happens then?
The insurer transfers the excess risk to a reinsurance company. So let's say John applies for $15 million with Insure 4 Life. If Insure 4 Life's retention limit is $10 million, they'll underwrite the full $15 million policy, but then they'll reinsure that extra $5 million with, say, Rizurco, a dedicated reinsurance carrier.
And does John, the policyholder, have to deal with two different companies?
No, absolutely not. It's invisible to him. John pays his full premium to Insure 4 Life. Insure 4 Life then pays a premium to Resure for taking on that excess risk. If John dies, Insure 4 Life pays the full $15 million, and then Resure reimburses Insure 4 Life for their $5 million share. It's a safety net for the primary insurer.
That system really makes the whole process robust. Okay, so once underwriting is done, premium is paid, we get to the final crucial step: policy delivery and activation.
Traditionally, this was a face-to-face meeting with the agent. You'd go over the policy and critically verify nothing had changed since the application date. Today, a lot of that is electronic.
But if it's an older or larger policy that still requires that personal delivery, what's the agent's final mandatory check?
The agent has to review the major provisions, the grace period, incontestability, suicide exclusion, but they also must confirm with the applicant that there has been no material change
No material change in what?
in their health, occupation, recreational activities, or financial status. Anything significant that's changed since they first submitted the application.
So if I applied 3 weeks ago, but yesterday I got a diagnosis for a serious high-risk condition, I absolutely have to disclose that.
You absolutely must. If the applicant fails to confirm that, or if the agent even suspects there's been a change, the agent is obligated not to complete the delivery. The policy isn't in force until that's done. They have to contact the underwriter for a reevaluation.
Wow. Okay, so once delivery is complete, the policyholder signs an acknowledgement, and then a critical window opens up for the consumer.
Yes. The right of rescission. It's commonly known as the 10-day free look provision. The law mandates a minimum of 10 days to review the entire contract. If you decide you don't want it for any reason at all, you can return the policy for a cancellation and get a full refund of all premiums paid. It's your final safety net.
That whole process covers individual life insurance. But many of us get coverage through an employer or a bank loan. How does underwriting differ for group life insurance?
The primary difference is the focus shifts from the individual to the group. For basic group coverage, underwriting is done on the group as a whole, the mix of ages, genders, occupations. A base amount of coverage is offered regardless of your individual health.
So even if I have a pre-existing condition, I still get that base coverage.
Correct. The risk is spread across the entire pool. The premiums for the group are then recalculated every year based on changes to the group's demographics and claims experience.
But if a group member wants to buy more coverage beyond that base amount,
then they usually have to prove insurability again. For that extra coverage, they're assessed individually, and the premiums are typically based on their age and, very importantly, their smoking status.
Our sources highlight that the trickiest type of this convenience coverage is creditor life insurance, the kind tied to a mortgage. It seems easy, but it contains a massive hidden landmine.
It does. Creditor life is appealing because it usually only requires some basic health questions. It often leads to automatic approval up to a certain limit, say $500,000. But the critical warning here is something called post-claim underwriting.
Walk us through what that means. Why is it such a major risk?
Because there's so little screening at the application stage, the insurer may only conduct a thorough, deep underwriting review after the insured person dies and the claim is filed. They go back, they pull the deceased medical records, and they compare everything against those few questions that were answered on the original application years ago.
So the family assumes they have coverage, but the insurance company's only now deciding if the deceased ever really qualified in the first place.
Precisely. And this review can lead to the claim being denied. They might find the deceased, perhaps unknowingly, misrepresented their health or never technically qualified based on the policy's fine print. And this denial happens at the exact moment the family is relying on that money to pay off the mortgage. And at that point, there's zero opportunity to go get other insurance.
Wow. So the apparent ease and convenience of getting creditor life at the bank comes with this devastating fundamental risk to the certainty of the coverage itself.
It raises a very serious question about assurance. Individual underwriting gives you certainty when the policy is delivered. Creditor life can provide coverage that is contingent on a review that only happens after death.
That profound difference in certainty is really the key takeaway here. We've seen the huge financial variance between preferred and rated risk classes, the power you have to upgrade a rated policy, and your absolute right to that 10-day free look.
And we've seen the rock-solid assurance from an individually underwritten policy versus the potential risk of denial through that hidden process of post-claim underwriting. And this raises a really important question for you to think about. When you're covering a major liability, like a mortgage, should the apparent ease and convenience of creditor insurance outweigh the greater assurance and certainty you get from an individually underwritten policy?
Something critical for you to mull over as you review your own policies with this new knowledge. Thank you for joining us on this deep dive.